Hi everybody, and welcome along to the Mint monthly update for the single asset class funds. Today you've got myself, David Fyfe, and fellow portfolio manager John Middleton joining us to run through the month of February and what we saw in markets. Just thought before we get into what the local markets did, we touched on a couple of interesting pieces we've seen over February. We certainly saw some volatility, and one of the key areas this was never more obvious was actually around the interesting space of cryptocurrencies and gold, of course. Now, traditionally, people have talked, to be fair, of both as a sort of a risk-on safe haven, but as we can see with cryptocurrencies and their volatility in prices, it certainly doesn't appear to be the case at all. Doesn't appear to be digital gold, as some would say. And in fact, the month of February, we saw record outflows from crypto ETFs. And in fact, we saw record inflows for the month of February for gold. So certainly doesn't provide that risk off. And I guess we saw a few different reasons for that. Some of it, of course, was the US government talking up the ability to have a Federal Reserve in crypto, and we saw them sort of talk about the way they were going to use that, and some of that was going to be criminal seizures rather than necessarily buying on market. But additionally, of course, in a world where we have lower real yields with higher inflation from Trump's tariffs, etc., we have seen the demand for gold go up and from there and stronger as well. So certainly an interesting start, but one we'll keep an eye on, and certainly with our view that fundamentals on crypto markets can be challenging, it'll be on to see how that plays out further. Now, rolling over to local markets, in the New Zealand market, it was a pretty challenging month. NZX 50 was down 3% for the month, but I just thought it'd be interesting to show the chart there in terms of what drove the results and what drove earnings for the month. But as we can see in the picture there, the chart to the right in blue is the stocks that were more exposed to the global markets, with domestics in the darker shade there. And as we can see, the local companies with more global and offshore exposure tended to outperform the local ones. Now, in terms of local names, we did see a few pretty poor outcomes. Fletcher Building was one, for example, but to be fair, we were somewhat expected, so no worse than feared. Another one was Sky City, where of course we saw foot traffic back to the casino, but unfortunately people are certainly not spending, and year-on-year decline is down 10% for like spenders. And again, we saw the fourth downgrade in a row from Spark, so another tough year for the cyclical names. But where did we see some outperformance in the month? Well, one of the stronger names was A2. I had a very strong month indeed, and in fact, in our view, may have slightly overshot. But I guess, it was a company that had some supply chain issues earlier in the year. Those were quickly resolved. Additionally, we saw some strong sales in areas that haven't performed well for them for a while, around sort of liquid in the US, and also their MVM business, which is an ingredients business. But where they really outshone and surprised everyone was their English label infant formula product. Now, there's a lot of us that follow the data that gives us a lead indicator of how it's performing, and as it turns out, it was where they are growing in the rest of China has been harder to capture within these data series. So they do what they call an O2O, which is online to offline channel. And it's really been where they've been growing strongly in the lower tier cities in China. And as it turned out, they've done particularly well. So we saw that as a big beat. And the stock rallied hard. Obviously, market share is really important for a business like A2 in China, given the China birth rates have been challenged in the last few years. And so it was good to see them perform well there. So they've executed rather well. Additionally, we saw the first dividend from A2 as well for the first half, as capital management has now been introduced. With a balance sheet of nearly $1 billion of cash, it's unsurprising they decided to make the call to distribute some of that to investors. Additionally, what are we waiting on from here? We're certainly looking to see what they do in their supply chain, looking to spend around 300 to 400 million supposedly on an asset, waiting to hear what they do, but that is something a priority for them. And I guess, the market certainly believes that with that will come some additional capital returns. So we're certainly seeing strong performance with the share price up nearly 40% for the month of February. Another name that had a strong performance for the month was Vista. Again, we saw a strong second half with them, stronger margins, certainly a beat ahead of what they'd guided to at around 19% if you exclude FX, which is well ahead of their 13 to 14 they'd talked to. And what drove this? A couple of different areas. One of them was actually a stronger box office. It looks like people returned to the movies. A few stronger titles out there saw people go back. But also another one was really around the move to the SaaS transition, which is really the key piece that people are watching on Vista for the market for the year. And what we did see as well is we saw them upgrade their long-term expectations on EBITDA margins. Previously, it had been 25 to 30. They took the opportunity to upgrade this to 33 to 37. And that was certainly at the higher end of our expectations and a few others in the market. So it was certainly a strong lead for where they see the business. We've certainly seen some corporate activity within the stock, and we know that the shareholders are pretty keen there to push for a strong outcome. And again, the cloud transition is a big part of it and one that we'll keep watching closely. On the negative side, we did actually see a slight miss on their full cloud transition in terms of number of customers, and it's one we're keeping a close eye on. I guess we were a little bit skeptical, having talked to some of the cinema operators in the US and other areas. I think the ability to move to a full cloud platform is somewhat reliant on whether it's fiber or internet connections within certain regions. So we know there are some challenges, but at the end of the day, it appears that Vista continues to perform well. It's just really what you want to pay for a stock like this at the moment, is where we're sort of having a bit of a struggle. But one of the other sectors that we've been keeping a close eye on in New Zealand has been the gentailers. Now, they had a fantastic year last year, and as we head into winter 25, we're now looking at a year that's gone from a drought last year through to excess rain with high storage in the lakes to what is now a very, very dry finish to summer. And companies like Meridian are now looking at an earnings for first half that we saw from them, which was quite a bit disappointing and well below normal hydro conditions. And again, if you look at the inflows into the lakes for both Meridian and some of the contact catchments as well, and even in the North Island for Mercury, they're actually below the 1 percentile. So these are very, very dry starts to or finishes to summer, sorry. So it's something we're keeping a close eye on. Now, these can normalize pretty quickly, whether it's through big rains and storms or snow melt as well as we head more into later into winter. We are looking and keeping a close eye on, but there's certainly risk, especially for Meridian, for earnings in the second half of this year. So one will keep it very close and your eye on. Now, one last one to touch on, which we couldn't miss in the month, of course, was the capital raise from Ryman Healthcare. While a little bit of a surprise in terms of timing, it never is in terms of the balance sheet themselves. They did need to raise capital in our view. The balance sheet was looking a bit challenged. But we did see this a lot bigger than we thought, which was around $1 billion raised at quite a large discount, over 30% from the last price. And this was seen at about 0.6 of their NTA. Now, I guess, a big discount was required to get this across the line. But what have we seen? We've seen the company's gearing reduced to around 20% now, which is a lot lower than we would have expected. And it's also been interesting to see that they now have more than $500 million worth of stock. There's units in both care and the retirement villages that now sort of near $500 million, as I was saying. So that could further reduce gearing once they sell through some of that stock. But what disappointed and has been weighing on the share price since, in our view, has also been the build rate. If you're raising to solve for a balance sheet, you hope it's helping to support growth. And what we've seen is the build rate nearly halve. I think the company's looking to complete around 900 units this year. They're now guiding to more like 500 for the next few. So this is certainly the lower end. And additionally, we saw the company downgrade their free cash flow generated from the business to the lower end as well. And we were told earlier by the business that, judge them by the cash flow. And unfortunately, that has again been a little bit weak. Now, I guess the near-term sales for them in Q4 has been particularly tough, and they've talked up, competition in the market. The interesting piece, of course, is that we're seeing updates from Somerset as well as OCA that probably didn't quite match that bleak outcome given by Ryman. So I think it's more a case of execution from them for now, but it's a name we'll keep a close eye on and one we'll see. And we did, of course, participate in the raise, but it's again a name we're keeping close on as they roll through the year. I'll now pass over to John to touch on the Australasian Fund.
Yeah, thanks, Dave. Switching across to the Australasian Fund. Again, another decent month for the Australasian Fund in line with the SRI Fund, both up about 100 basis points versus benchmark. And in AET, the pleasing thing was that the Australian market is actually weaker than NZ. So solid performance. The reality is the fund's fared pretty well in terms of reporting season. Yes, we could have owned a bit more A2 and a little bit less WiseTech, but fundamentally, I think we had a pretty solid reporting season. The key drivers of performance for the fund were basically Spark, Ryman, and Megaport. And so I was going to dig into that a little bit in terms of explanation of what happened. So Spark, as sort of Dave mentioned, we've been underweight for some time. And unfortunately, they delivered a weaker than expected result. And again, my sort of key takeaway from the conference call was the fact that the first question was about dividends, and management answered the dividend by essentially saying, look, we're only paying current dividend because we sold the towers, so the implications that dividend will fall going forward, which was certainly a surprise to me that they've been as direct as that. Underlying that, well, what is the problem? Well, the reality is they're still losing share on the mobile business to basically 2 degrees. And haven't really done much to abate that. And the bottom line is we think the dividend should be nearer to 15 cents going forward rather than the 25 cents they're supposed to pay out in the current year or 22 cents next year. So we still think there's a bit of downside pain to come on the dividend. And I would say that I think the credit rating agency sort of agreed with us as they put Spark on a negative credit watch to their A- rating. So, Spark was a strong amount of performance for us. Megaport ditto. Again, it's had a pretty torrid time and basically delivered a set of results broadly in line with expectations, and that caused quite a large relief bounce. As we've been talking about a few times, the reality was I think they delivered the evidence that we've been looking for, that the new sales part of the business is actually delivering quite well, benefiting from extra resource in terms of salespeople. But arguably, more importantly, also that the short-term earnings risk from back book attrition is hopefully behind us now. If you remember, they raised prices a couple of years ago, which bolstered earnings, but then drove basically sort of longer term customers to leave the business. And that seems to be slowing, which is supporting earnings over the medium term. And then finally, I talk about is WiseTech. Again, it was a negative driver of attribution for us. Basically not earnings related. The result they delivered was pretty solid. And actually there is evidence that the new product that they're starting to roll out is getting traction with select customers. But unfortunately, we got further revelations about misdemeanors by the CEO, which led to a couple of the board members departing. And obviously that weighed on the stock and our return. Looking to the chart on the right, I thought this was a pretty good way of highlighting what happened in February. Essentially, it's the ASX 200 by sector and then calling out the best and worst performers within the sector. Dave alluded to it. It was a pretty volatile reporting season. And I think, the interesting thing from this table is, on both sides of the ledger, you have things up 20, 30% or down 20, 30%. And really on most days, we did see double-digit moves in shares, in stocks. That's sort of good and bad news. Obviously, a lot of volatility, but a lot more liquidity in the sector, in the market, which I take as a good sign. But overall, it was a pretty rollercoaster month. And then finally, just in terms of positioning, essentially we added to our positions in Suncorp, Fletchers, and SRG, and funded that by taking a little bit of profit out of EBOS and Somerset. And also we used those to fund the Ryman capital raise, which we participated in. Switching across to the property fund, again, a difficult month for property markets, even if the property index did sort of slightly outperform the NZ 50. Essentially, the fund performance was weighed down pretty much by the Goodman Group capital raise, which I'll come on to. We did get a mini reporting season in February. Precinct, Vital Healthcare, PFI, and NZL all reported. And the reality weren't huge revelations. Basically, all those results were broadly in line with expectations. We do get the rest of the sector reporting in May. Key highlights, I would say, well, first and foremost was Goodman Group. Again, actually it was a solid result. Maybe the outlook was a little bit light from what we were going for, but the big news was they chose to raise 4 billion in a placement, which was conducted at a 7% discount to the last price at $33.50, and was basically there to fund their investment in data centers over the medium term. So a big cash raise for what is a big component of the index, and a lot of funding from the sector to fund that investment. Unfortunately, as seems to be the way at the moment, most of these capital raises means that the stock trades straight to the new issue price, ignoring the TERP, etc. And obviously that weighed on the GMG share price and the index performance. Second thing to flag would just be Precinct. Not so much the result, which was solid, but they've recently just sold a hotel at 1 Queen Street for 180 million to basically a Singaporean hotel property fund. The good news is it was a 5 to 8% premium to book, and I think that's good news for a few reasons. First of all, obviously highlighting the underlying value of the assets they have on the balance sheet, particularly if you can sell an asset for more than that. Two, interesting to see the buyer was actually a foreigner, an international fund. And, to be perfectly honest, I think international investment in New Zealand has been conspicuous by its absence in the last couple of years. So clearly, if the right assets are there, then, big international businesses are willing to pay for them. And I think that's the third thing I just flag. It does highlight that I think the likes of Precinct, Goodman, GMT, KPG and Stride to a certain extent are, bigger, higher quality businesses with quite, interesting assets for foreign third parties. So, one, we think this is a sign of things to come for Precinct. There are some concerns that they are, if they are going to fund the downtown car park, they're going to need further proceeds. I think the reality is they will look to sell down their current asset base or, invite international third parties to join the consortium to build the downtown car park. And as such, we think, the investment for that is pretty safe and secure, and so is the dividend. And then the final thing I just flag is that PFI issued a 150 million bond paying a 5.43% interest rate. Few things to point on that, to note on that. First of all, it's intended to be a 100 million placement and obviously upsized, so a lot of demand. And I think it ended up 2 times oversubscribed. So, from that, I would take that, a sort of low risk, reliable 5% return is pretty sought after. And I think this is the sort of highlight of the property sector. Most of the dividends for the sector are there or thereabouts. And if we do get the further interest rate cuts that we are expecting, I would think that the safe or relatively safe dividends offered by the sector will be attractive to the market in general. So that was that. Looking to the chart on the right, I just thought I'd highlight the impact of Goodman Group on the A-REIT sector. It's a bit like Fisher & Paykel Healthcare to the wider market in New Zealand. I mean, it is a significant component of the index and obviously contributes a significant amount of growth, which is roughly double what the sector is offering on a stock-by-stock basis. So clearly, if they are going to do a big capital raise, then it will materially affect the sector. And essentially, I think that's broadly what happened in February. We did make a few minor changes to the fund during the period. We did add HMC to the fund and bought a bit more KPG and Goodman Group in the raise. And also we funded that through basically selling the XDC and a little bit of Precinct and Stride. Anyway, that is the end of the update for February. As usual, if you do have any questions, please drop us a line at info@mintasset.co.nz, and we look forward to speaking to you in about a month.